Emmanuel Abolo is the Chief Economist and Head of Group Management Risk at Access Bank, and he's joining us now from our studios in Nigeria to discuss the current state of the Nigerian economy and the prospects going forward. Thank you very much, Emmanuel, for coming through. We've just heard from the U.S. Federal Reserve this week downgrading their outlook for the American economy from proceeding recovery to slowed recovery, and that sent a bit of jitters into the international market. Is Nigeria affected at all by events internationally?
Yes, let me say that events that happen in some other parts of the world have a way of affecting other economies because of the interconnectedness of the global economy. If that is happening in the U.S., certainly it's going to impact on Nigeria. The same way you would say that what is happening in the Eurozone would also have a way of transmitting, a negative impact on what happens in Nigeria. So I would say yes, that it will certainly affect Nigeria.
All right, one of the ways in which slowed growth is going to affect Nigeria is in the pricing of oil and in the reserve position for the country. We know that slowed growth generally means slowed industrial output, and industrial output needing oil. It's created volatility in the oil price. It's led it to drop significantly within the last 18 months, but recover from those lows that we'd seen in 2008. The situation, though, is that with the prices of oil not being what they ought to be, we've seen Nigeria's reserve position shift from $52 billion to $37 billion. Certainly that should have an impact on the fiscus. What's your assessment?
Yes, certainly. The Nigerian economy is a monoproduct economy. And certainly if the price of oil comes down too heavily, it is going to affect the country's external reserves. I must say that. But currently at 37 billion naira, don't also forget that the benchmark for the 2010 budget has been revised downwards to $60 per barrel. So certainly there will be some pressure on the external reserves. But again, we also have to be able to tie that to what is happening on the output side. So basically, are we going to see a situation where the price for oil will fall below $60 per barrel? That's not very likely. But the point you're making is very true, that what is happening in the U.S. will affect our external reserve position, and that could be a source of concern. Okay.
All right. On the bright side, though, the overall growth for 2010 is forecast in Nigeria to be somewhere in the region of 7.74%, which is a good number when you consider the African average being about 4% and within the rest of the world being much less than that. What are the drivers of growth if it's not going to be oil?
The main drivers of GDP growth in Nigeria has been the non-oil sector, and that has been on for quite some time. And essentially, when we talk about the non-oil sector, here we are talking about agriculture, wholesale and retail trade, and of course, services. The situation is not going to change for the near term. This will continue to be the key drivers of GDP growth, and of course, we have very good weather for this year, so that is still going to be the situation. But on the oil side, if we take away the issue of oil price not getting below $60 per barrel, then we are saying that on the output side, there has been some relative peace in the Niger Delta, and if that is sustained, and we hope it is going to be sustained, then we say that forecast or estimate of GDP growth at over 7% for year-end 2010, that is very, very achievable.
All right, now let's talk about the incumbent risks within the economy. Inflation for June at 10.3%, so it's coming down from figures we'd seen earlier in the year, but there is a sense that the inflationary pressures persist because unemployment is really high in Nigeria, and wages, although stable, there is a sense that you just don't have enough momentum for consumerism within the economy. The credit cycle is something to be concerned about, and the government although the budget has been revised, we've seen numerous supplementary budgets to try to augment the work of government in other areas, not least the elections coming up in January of 2011. What sort of pressure is that going to put on the monetary position in Nigeria and just the general ability of the Nigerian consumer to perform and try to boost the economy?
Well, let me just make this point that there will be very, very serious pressure on inflation. These pressures are coming from the fact that the asset management company of Nigeria, some money will come from there. And then, of course, moving towards an election year will also serve as a key driver of pressure on monetary aggregates. So to that extent, the inflation at 10.3% will be a little bit difficult to defend. These kinds of liquidity injections and pressure, monetary pressures will make it a little bit difficult. Of course, let me just make this point. There are basically three trios that you would normally refer to in economics. You have inflation, you have interest rate, and you have exchange rate. It's difficult to maintain both, to want to defend both. But I think at some point in time, the focus of government will be to see how to have a kind of delicate act of balancing, trying to defend the exchange rate, and also, of course, issues of inflation and the interest rate. But from what we have seen so far, I think government, and I'm talking about the monetary authorities, would like to see rates, coming down, and of course also defend the exchange rate. So you're quite right in saying that there will be a lot of pressure, but of course that what will happen will depend on ability and also the determination to make sure that things do not go out of hand.
All right.